I'm Charlotte McLeod with investingnews.com, and here today with me is Brett Heath, CEO and Director at Metalla Royalty. Thank you so much for being here. Great to have you.
Thanks for having me.
Really good to be speaking with you, and we couldn't remember when we're picking up this conversation from. So I think a good place to start is looking really broadly at the gold sector. Where do you think we are in the cycle right now?
I think we're at the beginning of the cycle. When you look at the physical metal, it's in a clear uptrend. It's been incredibly resilient. Most of this demand has been from central banks around the world. When you look at kind of the big buyers of gold, which are, mostly kind of the emerging market type of economies, and you look at a percentage of gold as part of the reserves, most of these are between like 5 and 10%. And when you look at the US, France, Italy, Germany, we've got over 60%. So we've got big buyers that have kind of made a decision that they want to make gold more or a larger part of kind of their foreign reserves. And I think there's a long ways to go. We haven't seen, up until really this last couple weeks, we have not seen participation from retail or from institutions, or really from the West in general. We've just started to see a little bit of that within the last couple of weeks, which is really interesting, because I think that, with the central banks buying, and if you get institutions and retail involved as well, I think it can propel the price of gold much kind of higher and much faster than I think what most participants expect.
Okay, a number of points I think we can pick up on there. And I'll start with central banks, because I think, as we all know, central banks have been very supportive for the gold price recently. I've seen some concern about China pausing its buying for the last couple of months. Maybe the price has gotten a little bit too high. What are you seeing there? Do you think that's just a blip on the radar?
I think China will probably, at least on the official tape, show that they purchase less. Now, we'll find out very shortly. I believe the data on central bank purchases for Q2 should come out here in the next week or so. So it'll be very interesting to see what that looks like. But, you can look at the overall trend. Maybe China comes back a little bit, but you'll probably see India, Brazil, Mexico. You'll see other emerging market economies probably buy quite a bit more.
And really interested also to hear you talk about that institutional and retail investor interest starting perhaps to pick back up. So what do you think is driving that? Because I know we've been waiting for that for quite some time, especially in the West.
Yeah, so I think, what we have today is not a free market, unfortunately. And we've got a world where, capital is kind of swirling around, and it's going to different places and very high levels of concentration. And a lot of that is driven off of basically the price of capital, which the Fed and the other central banks around the world, have been, manipulating over the last, call it 10 plus 15 years almost. And, what we've seen recently is we've seen a lot of that capital sucked up into big tech. And when you look at some of the extremes, some extremes that have only been seen once or twice over the last 100 years in regards to, 7 big companies representing over 30% of the S&P 500, and a number of other different types of metrics with basically big tech. A lot of that's being driven by AI. I believe we're starting to see some of that rotation out of those companies and really that part of the market. And, you don't realize that how big it has become over the last 10 years, where you've got multiple multi-trillion-dollar companies representing such a high level of concentration of capital. And so as that capital starts to rotate, out of those names, well, it's going to go somewhere. And, what we're seeing is a little bit of that start to tick up into physical, mainly into the physical ETFs. We're seeing, the GLD, we're seeing inflows the last 3 months. I believe it was a little over $1 billion. And the other ETFs, the other major kind of gold ETFs, which is a good way to kind of measure where capital is flowing. Obviously, capital could be flowing directly into the physical metal too, which won't be picked up on these types of things, but it's good to see. And so, watching kind of those fund flows, I think, is a key part of understanding, how things will perform, because today, like, fundamentals typically aren't the main drivers of that.
Yeah. Okay. So really interesting. So we'll watch to see, hopefully, that rotation continue going forward. And we'll come back to, I think, performance of the gold stocks. But before we go there, I want to definitely ask you about the Fed, because they just wrapped up within the last half hour or so, the latest meeting, leaving rates unchanged, which I think was very widely expected. What do you see as the path forward for the Fed in 2024 at this point?
Yeah. So it looks like the economy is weakening now. I mean, you look at, we were just in the middle of a reporting period, and you look at a number of multinational companies, unrelated to the gold or gold equities, and you're seeing finally some pretty significant, economic data. Like, you look at UPS, for example, they were way off, stock was way down. That's a good forward-looking indicator in regards to, how much stuff is moving and kind of the strength of the overall economy. And so I think we are going into a period where the economy is weakening, which will give the Fed enough to cut. So I think we do get a cut or two. If you look at the 2-year, which usually kind of leads this, looks like around 50 basis points maybe this year in total, whether that's one cut or two cuts. That's kind of what we see today. But I think going out a little bit further, I think people are expecting the Fed to cut and then cut back to zero. And I think what's going to happen here is, as the Fed cuts, when you look at M2 already starting to turn up, as the Fed does cut, I think we will see more of a kind of a reflation. We'll see inflation increase, and I think on the back of that cut, that the Fed is going to be in a position where they might have to raise, and maybe have to raise a lot sooner than most people have expectations of.
And when you talk about a weakening in the economy, are you in the recession camp?
I don't know if we're in a recession today. We're probably pretty close. I think we're pretty close. I think that when you look at the data today, I think that I wouldn't be surprised if it looks like maybe Q4 of this year. Obviously, recession data is backward looking, so you don't really know until the future, and you can kind of look back, and a lot of this data is not been the same over the years as well. So, but with the current data, I think probably by Q4, which I think will also play a role in the Fed making like probably one or two cuts this year.
Right. And when we talk about, the Fed and rates, one comment that I often hear is they can't really leave rates higher for too long due to the cost of servicing the debt. And one headline that I'd seen just in the last couple of days was debt went over $35 trillion for the first time. So any thoughts that you would want to share on that kind of questionable milestone?
Well, what I look at is not necessarily the total amount of debt. It's the amount of debt that needs to be refinanced in the next probably about 2.5 years, which is about 17 trillion. So call it, upwards of, half of the total debt having to be refinanced. Now, most of that debt is priced at 50 basis points. And so as that rolls over, if the Fed, obviously that they may cut kind of towards the end of this year, but even if they do only cut, call it 50 basis points, that debt is still rolling over from 50 basis points to 4% or maybe 4.5%. And, the interest expense or the increased interest expense from, holding that basically half of the debt that's outstanding rolling over in the next 2.5 years will, easily take the interest expense well over $1 trillion a year. So I think that obviously the rest of the world understands this. The U.S. has weaponized the dollar, and I think that's a big driver of why You see emerging market central banks diversifying out of U.S. Treasuries, buying more gold as a percentage of their foreign reserves. And I think they see this $17 trillion rolling over and understanding that, okay, that might not be the best picture in 2-3 years from now. And so, I think that that's a big driver of gold. I think that's why it's in such, it's been advancing in such a resilient fashion. It's pretty incredible to see.
Yeah, and if we put all of that together, not to mention with the geopolitical factors that continue, where do you see the gold price going in 2024? How high do you think we can get?
I think we could easily see anywhere between 2,600 and 3,000 this year. And potentially even closer to the latter number. And the reasoning is, again, we've seen one of the most significant breakouts like we've ever seen in gold, and there's very, very few people in this trade. So even up until a few weeks ago, there were significant outflows out of all of the metal ETFs. When you look at GLD, which is one of the largest precious metal ETFs, and you look back at data from when it was first created back in the early 2000s, it always had a pretty consistent correlation in regards to the amount of bullion or the kind of the assets under management versus the price. Like it would go up and down with the price. As the price was going up, people would buy more gold, and as it was going down, they would be selling it. And it wasn't until this year that we saw a very significant divergence for the first time, where we saw gold break out. At the same time gold was breaking out, there was a divergence basically across all the ETFs. There was sellers, and that's also consistent with a lot of the big bullion dealers, where they are still having, for incoming, phone calls, they're getting more sellers than buyers. So it just kind of tells you generally like where the public is on this, and how like you've seen such an incredible breakout, such an incredible setup, and the public's just not in the trade yet. And when they do come back in, I think on the back of some of these capital flows, then that'll be a big driver of not only gold but the equities, which today we still really have not seen any material inflows.
Yeah, and I think that's a great topic to go over for our audience, because I know that a lot of them are looking at a lot of people have been positioned for quite some time, and they're looking at their gold stocks and wondering, okay, when are they going to move? And I know typically we hear it starts with the producers and the royalty companies, and then we go down the chain. I was looking at Metalla's share price, which is about, I think, flat year to date, maybe a little bit up. So is that what you still expect to see? We're just waiting a little bit longer to get there?
Well, from a big picture perspective, the sector is going to need inflows, and when that capital starts to flow in through the ETFs, through the specialist institutions, it's all been the same. It's all been a kind of a slow bleed outflow, even in the midst of these breakouts. And so when that returns, I think we'll see a very significant move within these equities. A lot of the equities are very tightly held by very strong hands, just by nature of kind of the performance and call it the lack of patience with the general public, running to NVIDIA or Microsoft or one of these other big tech names, because they're performing very well, or at least they were up until the last few weeks. And so, for a company like Metalla, we're still a sub-billion market cap type of business, so that's considered small cap. We're going to need to see that capital come in, but also, I believe what's critical for us is really kind of the maturing of the business and really the profile changing, which is, I believe, what's starting in Q3 this year.
Yeah, I wanted to certainly touch on that. I know that the company has, I think, over 100 royalty and streaming assets at this point. So I think helpfully you've released recently a handbook so people can take a look and figure out what's going on at all of them. But what are you watching most closely heading into Q3 and the rest of 2024?
So what we're watching is we're watching very closely the advancements of the assets that are going to start production in the second half of this year, and then also in 2025. Just a few weeks back, we had Tocantinzinho, or G Mining announced that Tocantinzinho started production. This is going to be a very significant royalty for us in our portfolio. And also on the back of that, we had Sierra Madre announce that they started production at La Guitarra. That's another new royalty that's in production. That'll probably reach commercial production towards the end of the year. Our expectations are that, Tocantinzinho will be probably sometime in Q3. And then kind of going out a little bit further, we've got Amalgamated Kirkland, which is a royalty that is going to be in production likely in Q4. This is a Nico Eagle asset. And on the back of that, kind of probably in the first half of next year, we've got the Endeavor royalty, which is a big royalty for us. It's a 4% royalty. And, just those 4 royalties alone, approximately will double the production that we have for this year on an annualized basis. So we're at a position right now where, we're going to see nice stair steps in growth, nice stair steps in production for not just this year, but 25, 26, 27. We see this portfolio on everything that we've already bought and paid for, going from kind of the 25 to 3,500 gold equivalent ounces that we have had guidance on this year up to, approximately around 15,000 within the next 5 years on an annualized basis, really driven by, again, long life, great geology, great operator type of assets that will go for a very long time.
Would you be looking to make further acquisitions in this environment, or is the idea more that you've spent the time before gold is really going to get yourself set up?
We're always looking at acquisitions when we can find really good assets to bring into the portfolio. But I think the important part here is that, we took a step back and we really focused our business on the development side. And that was a function of being able to capture really what we believe is the optionality piece of the portfolio that I don't believe, and in our experience, we don't believe is well understood by the sector. And what I mean by optionality, I mean assets that we can pick up at an early enough stage where we know there's a very significant deposit, on this project, but even the operators don't fully understand the extent of it. And so we, at a time where we know that there's a lot of value here, we don't know the full extent. We do have a high level of confidence that at some point it'll go in production. And so, a perfect example of that was our Cote and Gosselin royalty that we picked up a few years back. And we bought this royalty for $6 million. It was an exploration stage royalty. It was pre-resource when we acquired the 1.35%. And today, that project now has already 7.4 million ounces. We think it's going to grow a lot bigger than that over the next few years and likely be integrated into the Cote mine plan, which Cote is already in production. And the royalty does cover about 6 to 10% of the reserves on Cote as well. So, capturing that, something where, you can pick up for $6 million, which will, likely easily yield well over $100 million over the life of the asset, is something that we like to find and understand. And when we have looked back, historically, these are the types of assets that really generate the outsized returns and the outsized performance for the royalty sector.
And I think on the note of understanding the strategy, I was going to ask you if you had any tips for evaluating royalty and streaming companies that investors could use, because it's an area of the mining sector that, of course, we always hear is safer, but it's also getting a little bit busier. It's not the very few companies that it used to be.
I mean, the most important part of if you're looking at investing in a royalty companies don't operate projects themselves. So you want to understand, what you're really buying is, this non-dilutive, free carried interest in this asset. So you want to look through the royalty company, and 100 assets, it's close to impossible for the average person to have time to go through all of these different projects. If you're an institution or you have access to institutional research, there's lots of research that is done for you, and you can try to get your hands on some of that. But if you don't have that, really the key thing is to look through the royalty company and look at the assets. Like, do they have good operators? Is it really great geology? Is there historically very big deposits that are found in this area? Is it a good jurisdiction? Most of the wealth in this world, when you look at it kind of on a global scale, if there is, a move into gold only represents about 2% of the world's total global wealth. And I mean all the gold that's above ground. So if the world decides that, okay, these paper currencies are probably not the best place to hide out in, and they want exposure to gold, to copper, to these metals that are kind of strategic for, maintaining the purchasing power, then they're going to have to find some of that exposure in the ground. And again, great assets, great jurisdictions. We feel that that's probably the safest way to own the gold, because when you have gold above the ground, that has, not likely, but, there's potential it can get seized from another government if you own it in a different jurisdiction, or there could be confiscation, or there could be taxes, there could be other things. But the gold in the ground in a good jurisdiction with a really great operator is, I think, the safest way to own it. And that's how we've built our portfolio from day one.
Okay, very good explanation. And before I let you go, any final thoughts or advice you would leave investors with? It really feels like we're on the cusp of something in the gold sector.
Yeah, I would. When I look at the sector today, and you look at the commodity price, you look at these trends that are very, very well in motion. There are some phenomenal opportunities within the equities today. And even the best companies that are out there, you can get sometimes at very, very attractive prices, particularly the ones that are called $1 billion market cap and below. So that's where I would look. And there's a lot of really high quality businesses that are in this range that I think will, as capital starts to return, be the leaders for this next cycle.
Okay, very nice point to wrap it up. Thank you so much for coming for my first in-person interview in this office. Great to have you.
Thanks for having me.
Of course, and once again, I'm Charlotte McLeod with investingnews.com, and this is Brett Heath with Metalla Royalty.